Price drops first, but it does not stay down. The session forms inside the same memory. May 25th Asia session forms almost exactly inside the May 22nd US session box. It overlaps. It repeats the same space. It does not open a new clean range. That matters. When a session forms almost identical to an older session box, the market is not free. It is returning to the same fight. The same upper side matters. The same lower side matters. The same midpoint matters. The trade does not begin from direction. It begins from where price fails inside that memory. May 25th Asia session first moves down. It reaches toward the May 21st US session lower boundary. That level is old memory. It is where price must either continue lower or stop falling. The move looks bearish. But the first move is not enough. A short needs entry, a stop, a target, a reason. Then price reacts. It does not collapse freely. It moves back up. It reaches toward the May 22nd US session upper boundary. Now the whole range becomes clear. Price is moving between the May 21st US lower boundary and the May 22nd US upper boundary. The session is not giving trend. It is giving rotation. The short appears first. Short entry line. May 25th Asia session midpoint. Stop loss line. May 22nd US session upper boundary. Take profit line. May 21st US session lower boundary. Risk-reward ratio 2.44. The midpoint becomes the short entry because price is trading inside overlapping memory. When the session overlaps almost exactly with the May 22nd US box, the midpoint becomes the decision line. Above it, buyers can keep the rotation alive. Below it, sellers can push price back toward the lower memory. So the short does not come from chasing the first drop. It comes from the midpoint failing. Price reaches the midpoint. It reacts. It cannot stay above. It returns lower. Now the short has structure. The stop sits at the May 22nd US session upper boundary. That line matters because the short uses the midpoint failure. If price climbs back to the May 22nd US upper boundary, the short has lost control. The market has reclaimed the upper side of the overlapped box. The short is no longer clean, so the stop belongs there. Not because it feels comfortable, because the structure changes there. The target sits at the May 21st US session lower boundary. That target connects to the downside memory already tested. Price moved down there before. If the midpoint fails again, that lower boundary becomes the next place where price can complete the rotation. The risk-reward ratio is 2.44. That is clean enough to consider, but it still needs behavior. Price must fail the midpoint. Distance must open. Reaction must not come back too fast. If price crosses the midpoint and immediately returns above it, there is no short. If price moves below it and builds distance, the short becomes active. Now the next setup appears. Price reaches the May 21st US lower boundary. It tests that lower memory. It does not continue smoothly. The downside begins to slow. Distance becomes shorter. Reaction starts to come back. Now the long can form. Long entry line. May 21st US session lower boundary. Stop loss line. April 21st US session upper boundary. Take profit line. May 22nd US session upper boundary. Risk-reward ratio 2.24. The long is not a random reversal. It forms because the lower boundary holds. Price already traveled from the midpoint area down into older memory. If sellers had full control, price should break lower and stay lower. It should move through the May 21st US lower boundary and create distance. But it does not. It reacts. It returns. That holding attempt creates the long. The entry sits at the May 21st U.S. lower boundary because that is where downside movement must prove continuation. If price cannot stay below that lower boundary, the short rotation has completed. The next move can rotate back up toward May 22nd U.S. upper memory. The stop sits at the April 21st U.S. session upper boundary. That stop is deeper. Why not tighter? Because lower memory can create noise. If the stop is placed too close under the May 21st U.S. lower boundary, normal reaction can touch it before the real move begins. Then price can still rotate up, but the position is gone. That is the pain of tight stops. A tighter stop can improve the visible ratio. It can allow bigger size. It can look cleaner, but it can also remove the trade before the target. So the stop must protect the structure. Not comfort. Not greed, not the desire for a bigger position. The target sits at the May 22nd U.S. session upper boundary. That is the top side of the same working range. If price holds the May 21st U.S. lower boundary and rotates back up, that upper boundary is the clean target. The same memory creates both trades. First, the midpoint fails. Short to lower memory. Then lower memory holds. Long to upper memory. Same box. Opposite direction. Different behavior. That is why direction alone is not enough. You do not say short all day. You do not say long all day. You trade the line that holds or fails. Now the trader type matters. An aggressive trader may use a tight stop. The stop distance becomes smaller. The position size can become larger. Sometimes, price never touches the tight stop. The trade pays fast. But the cost is real. Normal reaction can hit the stop. The trade idea can remain right. The account cannot collect. A conservative trader gives the trade more room. The stop is not too tight. The size becomes smaller. The position survives more noise. But the reward must still deserve the risk. If the wider stop makes the ratio too weak, the answer can be no trade. That is not fear. That is selection. Now, trailing. Trailing does not begin because the trader wants more. Trailing begins when price earns more distance. A practical trailing interval needs at least about 0.5 risk-reward unit of additional movement. Less than that can be noise. If you trail too early, normal reaction removes the position. If you trail too late, the trade gives back too much. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop cannot become too tight. If normal reaction touches it, the trail damages the trade. If the stop stays too far behind, the trail protects nothing. So the stop follows structure. Not emotion. Not the last candle. Partial profit can help. If price reaches the first target and reaction starts to speed up, protect more first. A conservative trader can take 60% first and leave 40% for continuation. If price holds the target and distance keeps growing, an aggressive trader can leave more open. An aggressive trader can take 40% first and leave 60% for continuation. If there are two trailing stages, a conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But percentages do not create edge. They only manage a trade that already has structure. May 25th Asia gives the lesson clearly. The session overlaps the May 22nd U.S. box. The midpoint gives the short. The May 21st U.S. lower boundary gives the long. The same memory flips the trade. Price reaches. It reacts. It holds or fails. Then the position appears. Price pushes up again. But the higher test does not stay free. The session forms inside compressed memory. May 26th U.S. session forms near the midpoint of the May 21st U.S. session box. It compresses by about 50%. It overlaps there. That matters. A compressed session can move fast, but fast movement does not always give clean direction. The box is smaller. The decision comes sooner. The reaction can also come sooner. May 26th U.S. session first moves up. It reaches the April 27th U.S. session lower boundary. That level has already mattered many times. It is old memory. It is not just another line. If price can reclaim it and hold above it, the long can continue. If price reaches it and cannot stay, the move can flip hard. Price reaches. It tests. It reacts. Then price drops. It breaks below the May 21st U.S. session upper boundary. It continues lower. It tries to reach the April 20th U.S. session upper boundary. It cannot fully test it. That matters. The drop is strong, but the lower target is not reached cleanly. So the trader must separate two things. The first trade is the long from the lower side. The second trade is the short after the higher failure. They are not the same decision. First setup. Long entry line. May 26th U.S. session lower boundary. Stop loss line. April 21st U.S. session upper boundary. Take profit line. May 25th U.S. session upper boundary. Trailing target. April 27th U.S. session lower boundary. Risk-reward ratio. 2.03. The long entry sits at the May 26th U.S. lower boundary. Why there? Because the session forms compressed near May 21st U.S. midpoint. The lower boundary becomes the place where buyers must defend the compressed session. If price holds that lower boundary and starts moving away, the long can build. If price loses it, there is no long. The stop sits at the April 21st U.S. session upper boundary. That is deeper memory. It gives the trade room. If price falls through that old memory, the long has lost its base. The compressed session is no longer protecting the position. The trade is damaged. The target sits at the May 25th U.S. session upper boundary. That is the first nearby memory above. If the lower boundary holds, the first clean push can aim there. Then the trailing target sits at the April 27th U.S. session lower boundary. That is the higher memory where price later tests. Risk-reward ratio. 2.03. The ratio is acceptable. But the long must be taken near the lower boundary. If the trader enters late, near the first target, the ratio breaks. If the stop is widened without reason, the ratio breaks. If the target is moved higher before price earns distance, the trade becomes hope. So the long needs discipline. Price must hold the lower boundary. Distance must open. Reaction must slow. Then the trade can work. But then comes the higher test. Price reaches the April 27th U.S. session lower boundary. It cannot stay free. Now the short appears. Additional short entry line. April 27th U.S. session lower boundary. Stop loss line. April 27th U.S. session upper boundary. Take profit line. May 25th U.S. session lower boundary. First trailing target. May 26th U.S. session lower boundary. Second trailing target. May 21st U.S. session lower boundary. Risk-reward ratio. 4.49. This is the stronger setup. The short entry sits at the April 27th U.S. lower boundary because price already tested that memory and failed to hold above it. If price reclaims April 27th U.S. lower boundary and keeps distance, the long can continue. But if price reaches that boundary and fails, the move flips. The lower boundary becomes the trap line. Price touches. It reacts. It cannot stay. Then sellers take control. That is the short. The stop sits at the April 27th U.S. upper boundary. If price recovers to that upper boundary, the short has lost the failure. The market has returned too far into April 27th memory. The short no longer controls the structure. So the stop belongs there. It may feel wide, but the target also opens. The first target is the May 25th U.S. lower boundary. That is where price can return after the April 27th failure. The first trailing target is the May 26th U.S. lower boundary. If price breaks lower and holds distance, the short can press into the active session base. The second trailing target is the May 21st U.S. lower boundary. That creates the larger return. Risk-reward ratio, 4.49. That is why the second trade is more attractive. The long was valid, but the short after failure gives stronger reward. Still, the number alone is not the trade. Price must fail the April 27th lower boundary. It must move away. It must not reclaim quickly. If it only wicks below and comes back, there is no short. If it loses the line and opens distance, the short becomes active. Now stop style matters again. An aggressive trader may tighten the stop. The ratio improves. Position size can increase. Sometimes this works. But a tight stop inside old memory can be dangerous. April 27th memory can create reaction. Price can move up, touch the stop, then fall. The idea can be correct. The position can be gone. A conservative trader places the stop where the idea truly fails. The size becomes smaller. The trade survives more noise. But the reward must still justify the risk. Here, the reward is strong enough to study. Risk-reward ratio, 4.49. That gives room. Now trailing matters. After the short reaches the first target, do not assume the second target. Price must earn it. If price reaches May 25th U.S. lower boundary and stalls, protect the trade. If price breaks and holds below, trail toward May 26th U.S. lower boundary. If price continues lower and fails to reclaim, trail toward May 21st U.S. lower boundary. The trailing interval should not be random. Use at least about 0.5 risk-reward unit of additional distance as a practical guide. If the move has not earned that distance, the trail may be too early. If it has earned that distance and the stop is still far away, the trade is exposed. When the target moves, the stop follows. But the stop follows structure. Not the last red candle. Not fear. Not excitement. Partial profit can help. A conservative trader can protect more at the first target. 60% first. 40% left. An aggressive trader can leave more for the second and third targets. 40% first. 60% left. With two trailing stages, a conservative trader can take 50%, 30%, 20%. A balanced trader can take 25%, 50%, 25%. An aggressive trader can take 20%, 30%, 50%. But the percentages only matter after the trade has earned structure. They do not fix bad entry. They do not fix late chasing. They do not fix unclear failure. Now, connect the day. May 26th U.S. forms compressed near May 21st U.S. midpoint. Price moves up to April 27th U.S. lower boundary. That is the first major test. A long can form from the May 26th U.S. lower boundary if buyers defend the compressed box. But after the April 27th test fails, the larger short appears. The short uses April 27th U.S. lower boundary as entry, April 27th U.S. upper boundary as stop, May 25th U.S. lower boundary as target, then May 26th U.S. lower boundary as first trail, then May 21st U.S. lower boundary as second trail. Risk-reward ratio, 4.49. That is the key. The first trade is valid. The second trade is stronger. But both require the same rule. Price reaches. It reacts. It holds or fails. Monthly, weekly, and daily charts explain why the movement looks violent. The intraday chart is not moving in empty space. It is rotating inside a larger memory. If today's movement feels confusing, step back. Look at the monthly chart. Look at the weekly chart. Look at the daily chart. The large time frame shows the pressure. The 1-hour chart shows the execution. Every day's entry and every response after entry becomes clearer when those frames align. The method stays the same. Higher time frame gives location. Session memory gives execution. Risk decides survival.